Good afternoon, everyone. Thank you for joining us at this media briefing, which will cover the discussions held over the last 2 days and how the MPC sees the global and domestic economic outlook. All members of the MPC are seated alongside me and are available to answer questions after the statement has been read. Since the previous meeting of the Monetary Policy Committee, the inflation outlook has deteriorated further, mainly as a result of external cost push factors. Underlying demand conditions remain relatively restrained and are not seen to pose a significant risk to the inflation outlook at this stage. However, there are elevated risks that these external price shocks could ultimately feed through to more generalized inflation. The domestic economic recovery has been sustained, although still at relatively moderate rates. Nor are there signs of a significant increase in employment. Moreover, the international outlook remains uncertain, and the economic recovery has become more hesitant in the past weeks, in the wake of renewed concerns about peripheral Europe, the earthquake in Japan, and higher commodity prices. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, increased to a higher-than-expected level of 4.1% in March 2011 from 3.7% in February. The main contributions to the inflation outcome came from food, housing and utilities, and transport, which together accounted for 2.9 percentage points. Food price inflation increased markedly to a year-on-year rate of 5.1% from 3.5% in February, while petrol and electricity prices increased at rates of 16.9% and 19.3% respectively. Administered price inflation, excluding petrol, remained unchanged at 9.1%. Underlying inflation pressures remained relatively stable, and in February and March, CPI inflation, excluding food and petrol, measured 3.4%, the lowest rate since September 2006. Year-on-year, producer price inflation reversed its recent downward trend and measured 6.7% and 7.3% in February and March, respectively. Electricity, mining and quarrying, and products of petroleum and coal were the main contributors to this upward trend. In contrast to developments at the CPI level, food price pressures remained relatively subdued in February and March. Agricultural and manufactured food prices increased by 2.7% and 2.9% respectively in March. Since the previous meeting of the MPC, there has been a further upward revision of the CPI forecast of the bank. Inflation is now expected to reach the upper limit of the inflation target range during the final quarter of 2011 and to peak at 6.3% in the first quarter of 2012 before returning to within the target range by the second quarter of 2012 and remaining close to the upper limit of the range for the rest of that year. Inflation is expected to average 5.1% in 2011 and 6% in 2012, compared with averages of 4.7% and 5.7% forecast at the time of the previous meeting. The upward adjustment is mainly due to revised assumptions regarding administered price increases over the forecast period. The survey of market analysts conducted by Reuters also reflects a further upward adjustment in the inflation forecasts. In the April survey, the mean forecast of CPI inflation measured 5% for 2011 and 5.8% for 2012, up from 4.8% and 5.7% respectively in the March survey. Expectations for 2013 were unchanged at 5.7%. The break-even inflation rates, as reflected in the yield differential between conventional government bonds and inflation-linked bonds, have also exhibited an upward trend. The global economic environment continues to be characterized by uneven recoveries within and across regions. Growth prospects in a number of the advanced economies, including the United States, the United Kingdom, and some European economies, remain uncertain in the face of the need for fiscal consolidation and risks posed by higher commodity prices, which have the potential to destabilize inflation and growth. Unemployment has also remained persistently high in a number of industrialized countries, notably in the United States and Spain. Spending in Europe in particular has been constrained in part by the undercapitalization of a significant portion of the banking sector. There are heightened concerns about the ability of some of the peripheral European countries, particularly Greece, Ireland, and Portugal, to meet their debt obligations, and this poses a systemic risk to the region. Lower growth in Japan and the disruption to the global supply chain caused by the earthquake and its aftermath are also likely to impact negatively on near-term global growth prospects. By contrast, growth in the emerging markets has generally remained strong, with evidence of overheating in some countries, particularly in Asia and Latin America. Global headline inflation has increased, driven primarily by higher food and other commodity prices, particularly oil. In the advanced economies, core inflation appears to be generally subdued against the backdrop of persistent output gaps. However, in a number of the emerging market economies, supply-side pressures have been accompanied by strong aggregate demand pressures and above-trend growth, resulting in a generally tighter monetary policy environment. Since the previous meeting of the MPC, the exchange rate of the rand against the US dollar has been relatively volatile. During this period, the rand fluctuated in a range of 6.95 Rand and 6.54 Rand against the US dollar, and on a trade-weighted basis, the rand depreciated by 0.9%. These developments were affected to a significant extent by the depreciation of the US dollar against other currencies, driven in part by the expected continuation of the accommodative stance of monetary policy in the US. The relatively strong rand exchange rate persisted, despite continued purchase of foreign exchange by the bank. Other factors underpinning rand strength during this period included strong commodity prices, the narrower current account deficit, and a resumption of portfolio flows to South Africa. Since the beginning of April, non-residents have purchased around 27.1 billion rand of domestic bonds and equities, and net purchases year-to-date stand at 14.5 billion. This marked a reversal of the negative trend in portfolio capital flows experienced by South Africa and some other emerging markets since the final quarter of 2010. Domestic economic growth is lower than that of our emerging market peers. The bank's forecast for economic growth is 3.6%, previously 3.7%, and 3.9% for 2011 and 2012, respectively. The composite leading business cycle indicator of the bank is suggestive of the continued recovery of the economy. Manufacturing sector output growth has improved somewhat against the backdrop of positive business confidence. In March, the year-on-year increase in the physical volume of manufacturing output measured 4.6%, compared with 5.7% in February. On a three-month basis, the increase was 4%. Consistent with this recovery, the Kagiso Purchasing Managers Index has remained above the neutral level since November 2010, although the positive trajectory seen in the past few months was reversed marginally in April. Despite these positive developments, the level of output remains below that attained before the global crisis, and the sector remains characterized by underutilized capacity. The utilization of production capacity measured 79.4% in February 2011, compared with 81.6% in November 2010, and 78.4% in February 2010. Mining output has been more subdued in the past months. Mining production declined by 1.4% on a year-on-year basis in March, but when comparing the 3 months to March with the preceding 3 months, an increase of 0.4% was recorded. The construction sector also remains under pressure, with the real value of building plans passed declining by 18.2% on a month-to-month basis in February and by 13.1% on a year-on-year basis. The FNB Civil Construction Index continued the downward trend that has been evident since 2008. The positive momentum observed in the past few quarters in the growth in household consumption expenditure appears to have been sustained. However, these levels are not giving rise to any obvious inflationary pressures, and there are tentative signs that this momentum may indeed be leveling off. Year-on-year real retail sales growth moderated from 6.3% in January to 5.6% in February. On a month-on-month basis, real retail sales declined by 1% in February, but increased by 2.2% when comparing the 3 months to February 2011 with the previous 3 months. Year-on-year growth in new vehicle sales declined to 8% in April from 22.8% in March. This slowdown has been ascribed to the high number of public holidays in that month and to the impact of the disaster in Japan on the sector. Growth in credit extension to the private sector remains relatively subdued. The 12-month growth rate of total loans and advances to the private sector measured 5.3% in March, but annualized growth in the first quarter of 2011 declined to 4.5% from 5.4% in the previous quarter. Growth was driven mainly by other loans and advances, particularly general loans, as well as by a recovery in installment sales and leasing finance, reflecting strong motor vehicle sales. 12-month growth in mortgage advances declined from a recent high of 4.8% in November 2010 to 2.9% in March 2011, consistent with a continued weakness in the housing market. Credit extension to the corporate sector increased at a year-on-year rate of 2.3% in March 2011, compared with 1.3% in January, amid tentative indications that banks may have relaxed their risk premia somewhat. Demand for credit by the household sector remains constrained by high debt levels and the high number of consumers with impaired debt records. The ratio of impaired advances to gross loans and advances has remained at around 5.8% since December 2010, mainly attributable to retail debt. The fact that this ratio has not declined further over the past 6 months is cause for concern. According to the quarterly Labour Force Bulletin, the Labour Force Survey published by Stats South Africa, the unemployment rate in the first quarter of 2011 stood at 25%, marginally lower than the 25.2% measured in the first quarter of 2010. Despite the unfavorable employment environment, wage settlements and unit labor cost increases remain at levels in excess of inflation. According to Andrew Levy Employment Publications, the overall wage settlement rate in collective bargaining agreements amounted to 8.2% in the first quarter of 2011. Unit labor costs increased by 7.7% in the fourth quarter of 2010, with labor productivity growth declining from 3.1% in the third quarter to 2.2% in the fourth quarter. The main risks to the inflation outlook continue to emanate from cost-push pressures, including administered prices. The acceleration in food price inflation is expected to persist for some time, despite indications that global food price inflation may have peaked. The international oil price has also displayed a marked degree of volatility in the past week, when prices fell as much as $13 in one day. Having risen sharply over recent weeks, the price of oil reached a peak of around $126 per barrel. The price of Brent crude oil today, the 12th of May, has fallen and is about $3 per barrel lower than that prevailing at the time of the previous MPC meeting. While international oil prices are not expected to decline further in the near term, it is unclear if prices will consolidate at current levels or if they will continue on their upward path. In the past 2 months, the domestic petrol price has increased by 8.8% and by 17.4% since the beginning of this year. The MPC continues to be of the view that the underlying inflationary pressures are mainly of a cost-push nature. These developments are expected to result in a temporary breach of the upper limit of the target band during the first quarter of 2012. It is recognized that these pressures have the real potential to generate second-round effects, which can result in more generalized inflation. In the light of the above, the MPC has decided to keep the repo rate unchanged at 5.5% per annum for the time being. Given the upside risks to the inflation outlook, the MPC will monitor closely any indications of second-round effects on inflation emanating from these cost pressures. The MPC will not hesitate to respond timeously to signs that threaten to move inflation out of the target range on a sustained basis. In addition, the MPC will remain vigilant with respect to any inflation risks that could emanate from domestic demand developments. Thank you. Okay, we're ready for questions. You ready for questions, everyone? Miriam?
Thank you. Mary Misa from Business Day. The bank is now forecasting a temporary breach of the inflation target next year. How exactly can the bank justify keeping rates unchanged at this point, and what would it take for the bank to raise rates? How would you measure the secondary round effects?
I thought that we'd set that out quite carefully in our statement. We're saying that there is a temporary breach as things stand, and obviously the assumptions are constantly reviewed depending on the change of data as things move forward. But the pressures are cost push pressures, and therefore we do not think it's appropriate to raise rates at this point in time. What we would look for are signs that, and we obviously would not wait to see the outcome. We're going to look at it and say, well, when this actually has occurred, we will then act. Obviously, we will act timeously to signs that there are some pressures that that in raising interest rates would need to address, and that means that they're second round effects or coming from demand side. And that's what we will monitor very closely. So the fact that we see this as exogenous, that these are cost push pressures, that they result from things like your oil price spikes, mean that we do not see it appropriate to raise rates at this point in time. Yes.
Nampumelo Siziba from Summit TV. Governor, I wanted to ask, how concerned are you about the wage expectations that are being put out from some members of the public sector?
I don't think it's appropriate for us to comment on the specifics, but what we have pointed out in the statement is that the wage settlements are way above inflation still, and that it's very important for there to be a measure that takes account of what inflation and inflation expectations are when wage settlements are discussed. As I've said previously, I don't think it's appropriate just to emphasize wage settlements. I think it is also the settlements that management incurs, and I think that those are the kinds of issues that we need to look at. We've highlighted in the statement very clearly our concerns about where this level stands, and that it's very important that the inflation rate be factored in when people are looking at what settlement they want. But it's not for us to comment on the specifics of that. Yes, sir.
Chris Bishop, CNBC Africa. There is a school of thought among manufacturers who believe that with the currency, you said you've been buying a lot of currency recently, that perhaps you should intervene with a 10-year plan to keep the currency at 820 to 850, and under which conditions they say they could create a lot of jobs. They're saying that just watching the cycles is not good enough. You should have a solid plan for 10 years. What do you say to that?
I'm very pleased that they can predict 10 years ahead in this climate of uncertainty. Yes.
I want to know, what are the reasons for the bank's downward adjustment of the economic growth forecast?
I would really say that if you look at 3.7 to 3.6, it's very marginal. So it's pretty much on par. You know, it's very much in keeping with the outlook that we had. It's a very small and marginal adjustment that I wouldn't put too much emphasis on.
Sorry, I couldn't find the button. Franz Wild from Bloomberg. Governor, given that you're predicting that inflation does go above 6%, was there any discussion of raising the rates? And, I mean, was anyone in favor of it?
Both the discussion and the decision and the approach we want to take was completely unanimous in the meeting. And therefore, as we said, this is something that is driven largely by administered prices and exogenous shocks, and therefore we did not discuss raising rates at this point in time. It was not, there was complete consensus that this should be an unchanged position. However, as we said, again in that discussion, there's unanimity that there are upside risks and that there is something that the Monetary Policy Committee will be very vigilant about in looking at all of these, the numbers that come out, both in terms of domestic developments as well as global. Yes? Sorry, do you want to put the mic on? There we go.
Stella Mapens, also from Reuters News. Governor, commodity prices have been falling over the last couple of days. What impact do you see that having on the inflation outlook?
Well, it depends in terms of how long they stay down and what happens. As we said, if we looked at oil, oil has really been the main driver of the rise in inflation globally and domestically. So it's uncertain. It has been hugely volatile. As I indicated, its peak a couple of weeks ago was at $126 a barrel, and it looked like it would simply be continuing to rise. It's down today at considerably lower levels than that. And therefore, it depends on what happens. The fall has been a couple of days. And I think what it does emphasize is the uncertainty in the environment that we're all dealing with, because it's reacting to all kinds of issues. The question of the monetary policy stance of the United States, the question of peripheral countries in Europe. So there's a whole lot of issues around that. What we would do, as we said, is monitor it very closely, and we will see whether this is a sustained position, whether it rises or whether it settles. We don't know, and I'm not sure anybody really does. So we will watch it very closely. Clearly, it has an impact. Yes, sir.
Good afternoon, Governor. My name is Sidney Mudiba from Highway Africa. The metallic industry has been overcharging, and as the metallic industry has been overcharging recently, with ArcelorMittal being accused, and also there's so much collusive tendering with regard to tenders in this country. What's your take on that?
I think the issues around what has been happening with ArcelorMittal is under the Competition Commission, and everyone else is looking at that. The question of tenders and corruption, government has a very clear stance on tackling corruption. We want good governance in the country and stand for that, but it's not for us to comment on the specifics of what is happening in the case of ArcelorMittal. It is being addressed by other structures. Mariam?
Governor, the rand has depreciated quite sharply this week. Is there any concern on the bank side of the effect this could have on the outlook for inflation if it's sustained?
Well, I like your last part, if it's sustained. The question is, when we say it's depreciated sharply, I think that at the moment it's, what, 6.95? Might be 93 now. It was 95 earlier. When it was a little bit above 7 and it was reaching this, everybody was saying, it's appreciating so fast, what are we going to do about it? The essence of it is a below 7. It is still a very strong currency. It is volatile. It's among the most volatile. And that the volatility is certainly cause for concern. But I would be very reluctant to call it strong or weak when we're talking about the levels that we're at. You've got to remember where we were at the end of last year and what people have been saying about where you would like the currency to be. The point made in a 10-year horizon to be at 850, I think that's very bold. But all I'm raising with it, of course it matters, the volatility, and it affects the ability to take decisions. But this is not just a rand story. This is definitely also a dollar story, and we cannot look at the rand without looking at what's happening to the dollar, what's happening in the global markets. Yes, sir.
Good afternoon. The growth story, Governor, do you see the monetary policy still, playing a role in terms of supporting the economy, or do you think that now the economy is actually already showing serious signs of improvement? Then there's no need for the Reserve Bank to do more on that?
Well, our mandate in the clear sense is inflation and looking at price stability in the interests of sustainable growth. At this point in time, we have a repo rate that is steady, and that we recognize within that is that growth is improving, but not nearly at the levels that would enable there to be an impact on unemployment. And we think that we are adopting a stance of monetary policy that is appropriate for the circumstances that we are in, taking account of what our primary responsibility is. So You know, in terms of real rates, I don't think it is the level of interest rates that is the main impact on whether you can have growth or not. There are a lot of other factors that are affecting that. Helmer.
Good afternoon, Governor. Helmer Preuss, The New Age. Governor, can you share with us what the Reserve Bank's forecast is for first quarter GDP growth? And does the Reserve Bank undertake its own surveys of pricing power within the manufacturing or other sectors? Thank you.
No, I don't think so. The GDP numbers come out from Stats South Africa, not from ourselves. We obviously look at things directly, but those are the numbers that guide, and we are guided by what Stats South Africa does. Obviously, we actively engage with what is happening in the economy. But it's not that we develop a parallel. We look at what is in the national accounts. We look at all the kinds of numbers that are there. But GDP is a Stats South Africa number. We give our expectations of growth, which we have done in the statement. Yes, sir.
Governor, you said at the beginning of the year that you were assuming $90 a barrel. You were basing your assumption on. You said you'd revise that figure up at the last meeting. Can you give us an idea of what the assumption you're using now?
No, I would prefer not to give you an assumption other than to say that we do make assumptions that are related and relevant to what is happening to the oil price. So it is certainly revised upwards. Yes.
Governor, sorry, just earlier you said that the Iran above 7 or under 7, depending which way you're looking at it, is a strong rand. And then you said you don't want to say that it's strong or weak at this point. Could you just clarify exactly?
I'm saying I'm responding to the question that it's depreciating and that now at 6.93, is it a problem? I'm saying it's very difficult if you're looking at it at the moment to say is it strong or weak, because if you looked at it a few days ago, it would have been stronger, and if you looked at it a week or two ago or whenever it was in the 720s, it has also been there. So when you're at 720 and you appreciate to 690, it becomes a very strong appreciation. So I'm saying it's a volatile currency, and therefore it depends on the moment in time that you're looking at it, whether you're seeing it as appreciating or depreciating or strong or weak. And therefore it is a factor that you've got to take account of, that there is the volatility in the currency that is very high. So I'm not saying it's weak or what I'm saying is you can't say it's weak or strong of this moment because it depends where you're measuring it against. That's all I'm saying. And I'm saying within that, at 693, it is a strong currency. Yes.
Governor, do you have any theory as to why capital inflows reversed in the period that you looked at?
Perhaps I'd ask Daniel to look at that, because first of all, we had a very strong outflow from the last quarter of December and really up until April, which was quite significant, and it was in a number of emerging markets, not just ourselves. Bear in mind, within that, when you had the outflow, the currency continued to appreciate, by and large. So the discussion about whether you've got capital inflows and that affects the currency was a little bit turned on its head when you had the outflows and the currency continued to appreciate. The turnaround since April, I think, again, is a factor that relates to the stance of monetary policy in the US and in Europe, and sentiment. So people are really still looking for yield. That's what it's about. But perhaps, Daniel, you'd like to talk a little bit more about it.
Yeah, I think the points have been made, really, that the reversal and the renewed interest in not just South African bonds and equities, but into emerging markets generally, has had to do with the reassessment in terms of how long it would take for monetary policy to be normalized, adjusted in advanced economies, and that, given what we've heard recently and the news flow and the data flow has been, investors seem to think that that would take some time for that to be normalized, and that in addition to continued growth prospects that are positive that they're seeing in emerging economies. So that basically we've seen, for instance, a renewed push following the most recent press conference that the Fed gave, where they gave us an update of the assessment of how long they think policy might still remain accommodative in the US, for instance.
Before I take the next round, is there anything that anyone would like to add or say to any of the questions asked so far? Anyone? There's a question at the back.
Governor, a question via the webcast from Filippo Cipriani. His question is, words like vigilant and closely monitor have special significance for the investors and financial markets. Would this be reading too much into the statement, or does the SARB pick its words deliberately?
I would say we pick our words deliberately, and we will be very vigilant and closely monitor what is happening in the economy. And in essence, that's what, the market always asks for some guidance, and we're trying to give you guidance that we are concerned about where things are going, and we will look at it very closely. We didn't think it appropriate at this point in time to raise rates, but the risks are to the upside for the outlook. So yes, we choose our words very carefully. In fact, in terms of process from the committee, the statement is looked at line by line. Other questions? Anyone else? If not, thank you all very much for coming. Thank you for joining us today. We will see you again in a couple of months, and look forward to engaging with you on an ongoing basis in a very exciting and turbulent world.